Somewhere between turning 40 and planning for retirement, a lot of people decide it's safer to hand over their money to a money manager. They tell themselves, I don't know enough about investing, or someone else will probably do a better job. And I hear this every week. Smart, capable adults talking themselves out of learning something that's completely within their reach. But those money managers often charge, say, 1 to 2% in annual fees. By the time that everything compounds, this can easily erase around $30 to $100,000 from your life savings. And for what? A portfolio that often trails behind the market. So, if you're watching this, I want you to know that you can do this by yourself. You're disciplined enough, steady enough, and absolutely smart enough to manage your own investments without paying someone else to do the same thing that you can do with a brokerage app. If you're working with a money manager right now, this might be the moment where you can perhaps rethink that relationship. And if your money has been sitting in a bank account because you weren't sure where to start, then this might be the moment where you finally step forward. The people I help always look relieved once they start investing for themselves, and almost every single one of them says, I should have done this sooner. So, in this video, I'm going to walk you through exactly what I do with $100,000 in 2026, the same approach I teach in private, and how you can apply it to your own. The first step is, of course, very simple. You just want to open a brokerage account. This is where you're going to move your money, track your investments, and build your portfolio. It takes the place of, say, your bank or your money manager, but now you're the one who's making the decisions. When you open a brokerage account, your deposits land in a default holding area. But unlike a regular bank account that pays almost nothing, this money is immediately placed into a money market fund. This kind of works like a high-yield savings account that holds short-term, low-risk investments. Mostly, it's government-backed and it pays a competitive yield. It's the place your cash sits before you invest it or where you keep your money that you might need soon. You can think of it kind of like your brokerage's version of a high-yield savings account, except that it oftentimes will pay a little bit more. So the moment that you transfer your lump sum into your brokerage, your money starts earning. So if I had to pick a brokerage for ease and reliability, then of course I would choose Fidelity. When you move cash into your main Fidelity account, it's pretty nice because it automatically gets swept into their money market fund. Now, Schwab is a solid choice. I also use Schwab too, but there's a little bit more admin involved. Their default account doesn't automatically get swept into a money market fund, so you need to manually buy one. Now, don't freak out or anything because it's not difficult, but for beginners, the automatic sweep at Fidelity makes things so much easier. Once your brokerage is open, you can transfer your $100,000 or whatever amount that you're working with. And again, for this video, we're going to use $100,000 as our example. Well, the next step is creating specific investment accounts and dividing up your funds. For me, I believe it's best to keep around $5,000 to $10,000 in your money market fund. This is essentially your liquidity buffer, money that you can access immediately without selling investments or disrupting your long-term plan. Now that your brokerage is open and your $100,000 is sitting safely in your money market fund, you're ready to build your actual investment accounts. The first account is my favorite account, the Roth IRA. Think of this as your long-term retirement bucket where your money grows tax-free. You contribute after-tax dollars, and the growth, dividends, and withdrawals in retirement aren't taxed again. And really, very few accounts in the United States offer benefits like this. In 2026, if you're under 50, you can contribute up to $7,500 per year. If you're a little older, the IRS lets you play a little bit more catch-up, and your limit is $8,600 a year. And again, these numbers change most years, so it's always best to check irs.gov. What makes this account so valuable is how much it shelters over time. For example, imagine you're a, I don't know, 45-year-old store manager, and you contribute the maximum each year. If your returns average around, say, 10% for the next 10 years, you'd end up with roughly $120,000 inside your Roth IRA, and you keep the full amount when you decide to take it out later towards retirement. But if you use a regular investment account instead and earn the same returns on the same contributions, you'd owe taxes on your gains along the way. Over a decade, that can easily cost, say, $8,000 to $15,000, depending on your bracket and how often and how much you sell and withdraw. So before considering other accounts, I'd start by maxing out a Roth IRA for the year. Since you're starting with a $100,000 lump sum, you can put in your full annual contribution immediately. In the years that follow, you could set up an automatic monthly transfer for the correct amount, or about $625 per month if you're under 50, or around $717 per month if you're 50 or older. Now, in 2026, if you earn more than $168,000 as a single filer or $252,000 as a married couple, you can't contribute directly. But you can open a traditional IRA, contribute the same, $7,500 or $8,600 depending on your age, and then convert it into a Roth. This whole process, this whole thing, is called the backdoor Roth IRA. But make sure that you do the conversions immediately. If you move it within the hour, your tax bill is basically zero. Now, if you wait a few months and it grows, then yeah, you'll owe taxes on that growth, and it might be something like $20 or $30. It's also a good idea to have a tax professional check that Form 8606 is filed. This basically ensures that you don't get hit with double taxes and keeps your Roth conversion straightforward. Now, once your contributions land in your Roth IRA, don't stop there. Your money is in the accounts, but it hasn't been invested in anything yet. This is the moment that most beginners misunderstand. They assume that the contribution automatically buys shares, but it doesn't. You still need to choose what you want to invest and own. You can scroll through individual companies on your brokerage app, companies like Apple, Walmart, Costco, and you can buy shares one at a time. But my personal preference has always been ETFs, or exchange-traded funds. These are basically a basket of investments that give you instant diversification. So instead of betting on one single company, you're spreading your money across hundreds or thousands of them, which lowers your risk if one company underperforms. Now, there are more than 3,000 ETFs in the United States covering every category that you can think of. There are tech-heavy funds that cover companies like NVIDIA, AMD, and Microsoft, income-focused dividend funds, and steadier bond funds for lower-risk investors. Since your Roth IRA is designed for retirement, because, an IRA stands for an individual retirement account, I would keep things uncomplicated and focus on broad, long-term ETFs. So if I were opening a Roth IRA from scratch, I'd start with one of these. They're diversified, easy to understand, and historically reliable over long stretches of time. Now, if you're feeling uncomfortable with what I've said so far, then don't stress. You can always sign up for my one-on-one mentorship program with me and my team. We don't want to manage your money for you, we just want to teach you how to do it yourself. And based on if you qualify, we'll build a custom investing roadmap for you. If you're interested in this, I'll leave the application link down below. Once you've maxed out your Roth IRA, the next step is open a taxable brokerage account, or what I usually call